Everybody. This session will be about daily bias, all about daily bias, how we form it using narrative, strictly on the daily and weekly timeframes, using FVGs and liquidity, as well as using previous daily, weekly highs and lows, and old weekly and daily swing highs and swing lows. Okay. So before we get into the actual charts here, we have to understand what we're looking at when we're reading daily and weekly or even monthly candles, I should say, monthly as well as daily and weekly. It's applicable to all of the very high time frame candlestick charts. So to understand this, in these examples, we're just going to be talking about daily here, but this is all applicable for weekly and monthly as well. We need to understand what is a daily swing high formation, what is a sweep of the previous day, and how this affects our expected draw. So on the left here, we have a daily swing high formation, and this is a 3-candle pattern where there is a higher wick in the middle and 2 lower wicks on each side. You would have a daily swing high. On the low side, you'd have a higher wick on each side, the lower one in the middle, and this would give you a daily swing low, okay? The sweep of a previous daily high would be like this, where price in this daily candle comes up, takes this one, and closes below. Similarly, we have a sweep of the previous daily low, candle formation, low, manipulates liquidity underneath the previous day's low before pushing up, and then in this case, closing above the previous day's high. So how do we understand the expected draw for the next day? Well, we have to apply this thinking into the following day. So in this case here, we have a swing high formation. We've had a candle that's failed to close above this high and then printed bearish below this low and potentially below this swing low. We don't have the other candle here, but you can imagine that there's a candle here with a higher wick on the left, right? And we would expect that this high becomes our next immediate daily draw, okay? So what we would be looking for is potentially a manipulation to occur above 12 a.m. open to push down and take liquidity below the previous day's low, which would be this one. Alternatively, what can happen, and this is with pairing other POIs and forms of analysis and liquidity fractally, is we can see this liquidity get ran and frame up a potential reversal to push in a new daily candle. And in the event that this happens, then we would look left here on the daily and we'd ask ourselves, well, if there was a sweep here and a new bullish candle, what would be the next buy side target? So we would look at that next swing high. Keep in mind, we haven't gotten into pairing other forms of analysis like our FVGs, which tell us a lot about narrative, and this is strictly using price action of the daily candles. Here, we've had a sweep, or we formed a swing low, we pushed down, creating the low wick, pushed up, and then closed above this candle. This tells us that the next candle will likely push down, form some type of sell wick before pulling up, and then forming a new bullish candle. Similarly to here, you've had a sweep up, push down, creating a new lower bearish candle where the body closes below the previous one. And we expect that this will be the next draw. We'll form a buy side wick, push down and create a low, and then a close. So you would start with the open, create the high, create the low, and end off the day with the close. In this example here, just like before, we've had a sweep of the low now, pushed up, closed above the previous candle's high. So what we would expect, and what's the highest probability, that we would form a lower wick after the open, form the low of the day, push up, form the high of the day, and then come back down and form the close of the day. So it'd be open, low, high, close in a bullish scenario. And in a bearish scenario, it would be open, high, the low, and then the close. So we're looking and we're constantly thinking about how this candle will form through the following day, by both simply analyzing on a candle by candle basis and a swing formation basis, as well as our lower time frame forms of analysis and our sessions as well, tracking where the sessions have gone and how we can predict where the follow through of the day will be. The next very important mechanic for forming daily bias would be to understand the narrative that's delivered through FVGs, as well as, or successful FVGs, FVGs that produce the desired or intended move, and FVGs that fail to produce the intended move. So we here track that as ISPs because we understand that the mitigation of an FVG creates an ISP and should come and take the low, giving the intended result. Or in this case, a failed ISP because price has come, rebalanced, had a reaction down, and then we've seen that reaction fail. And that's giving us an indication that we'll then look for a buy side target in this case, or a sell side target, basically in the against the direction of the FVG. Okay, so if we go back here, we can study this on a candle by candle basis. We've had a swing formation with the lower wick on the left and on the right. Then this candle's broken down and closed below the previous candle. So we look at this to become the next draw on liquidity. We see again that happens here. This candle sweeps below, closes bullish, fails to close below, so fails to continue. So what we would look at is that this high gets swept, this high indeed gets swept, and then pushes down to then take the low, leaving a large gap. And then in this candle, we see that the low has closed, or the close is up below the previous day's low, so showing that follow through. And then the next candle, same thing, we get a close below and a wick above. So what price has done here was set the open, the high, the low, and then the close. And then in the next candle, we've had the open, the low, the high, and then the close. And what this is telling us is failure to follow through to the next candle. So we'd be looking to try and predict what the next draw on liquidity would be. So here we have a very clear daily FVG. So because we failed to push down further and continue this bearish momentum, we'd now be looking for a buy side area to cause an intraday reversal and then to continue to take that weaker swing low. Notice we're not looking to take the high here or the swing high here because we're still in bearish order flow, and we see that we do have a narrative that resides inside of the FVGs that are left behind. So when we tap into it, we're expecting a swing formation to form now, and we're expecting that this ISP here will succeed. And it does, and then it continues to take this low. And then here, same song and dance. We have a sweep of the previous daily high into a higher time frame FVG. And then we have a close that closed below the previous day's low with intent and below the swing low. So what we would expect for the following day would be, let you think for a second. Pause the video now if you want some time to think. The next candle would form the open, then it would form the high, and then it would come down, it would form the low, and then it would form the close. This is what we're betting on, and we're assuming that the next candle will be bearish, potentially, but at the very least, we'll take the low of this day before potentially reversing. This would be the draw on liquidity, the minimum draw on liquidity for the very next day. The next thing is failure or fair value gap failures, failure to follow through on its intended direction. So we call this a failed ISP because it's a failure to produce. This is not a failure to produce, a successful production of an ISP when we break that low. In this case here, we can see that price has tapped into this FEG once, pushed down, swept the low, pushed up very, very bullish, closed above the previous day's high after the sweep into the FEG. So this FEG has already produced a reaction to push us down here. Then this candle pushes up, creates another bullish candle, successfully filling the rest of this fair value gap, and then pushes down, closes. From here, we're expecting another bullish candle, but because we're coming from a high value area up in here, we're looking for price to potentially slow down. And we also understand that narrative technically structure is from here to here. So we have to build our narrative to ask ourselves the question if this is going to come and take out the low. So we wait for those answers. In the following day, we have a sweep of the previous daily high when we have this range bound candle. And this is an up candle. So what we would be expecting is at a minimum that this high would be taken and then potentially this swing high here. So the PDH is taken, price pushes down, takes out the low of this candle and closes below. So from here, what we would be expecting is that this low would be taken before this high, right? And we're expecting now to continue and take this low because we have had a reaction from this FEG. The following day, pushes down a sell side wick, creates a high and closes above, closing a bullish candle and failing to take this low. And then the next candle, we would ask what would be the minimum draw. We would assume that this high would be taken before this low and potentially this high as well, and then the swing high. And this happens. Now we've taken all the liquidity out. The next day sweeps the high, pushes above, closes below. So failure to follow through on the following day. So we can start to frame out a potential reversal from the higher time frame POI here. The next candle is bearish, sweeps below the previous day's low, but closes above. So again, failure to follow through. So now we're in chop. But what a lot of people will fail to realize is that just because we have a mechanical system doesn't mean that you can neglect price action. And if we see that this FEG is failing to produce lower, it's failing to produce lower, and then we've broken above it, we can start to look at this as a failed ISP and give it and use it to give us early indications of a reversal. And then we would ask ourselves, well, if this ISP is failing, if this FEG is failing to produce the desired result, then what liquidity is price drawing towards? And then we would look at the next area of liquidity to draw into. And we can see here again, we've swept the previous swing high and then closed below the previous day's high and the swing high. And we'd be looking for that next swing low to be drawn to. But ultimately, based on the narrative that's being built here through this failure of an FEG, we'd then look for this to be weak and this to be weak. When that is tapped into, we would start to expect a reversal to play out. Now, let's get some charts. Mute these here 1 second. All right. So we're going to apply this line of thinking to the charts here, right? So here we have a sweep above respected by this FEG here and the one above taps into this FEG. Then it closes above this candle's low. The next candle, we'd be looking to take out this swing high because it's in the direction of the FEGs and the direction of the structural breaks. Therefore, this is expected to be taken. The next day, it closes below. It takes the high, but closes below. So we'd be expecting a potential reversal in this area, or to frame one, because we're seeing a failure to follow through. So this ISP here is failing to give us the successful direction or produced results. Sorry, I just keep getting a lot of notifications. Give me 1 second. Let me just mute this. Okay. Now, here on the daily as well, obviously we're on the daily, but we've taken the high here. I mean, the next day we've taken the high, pushed down, closed a bearish candle, and now we'd be framing a narrative off of not just the sweep in the close, but also the narrative that relies on the operation of these FEGs, which is that this FEG should have put in a new high, but it hasn't. We've closed bearish now. So we'd be looking at this swing to potentially be weak, and then to this swing to also potentially be weak, because we understand that in bullish price action, these FEGs should produce the intended result. And in this case, it hasn't when we push down. And then it's confirmed when price breaks lower. And this is what we call failed ISP, of course. Now that we've had this failed ISP, we'd be looking and asking ourselves, where are we coming from and where are we going? What's the next form of liquidity that price wants to be drawn to? So we'd be looking past this FEG for the next area of liquidity, which would be this low. This low is drawn to. The body closure is above it. And from here, we would be expecting a potential reversal on the following day. We also see after this candle closes that we have an FEG. So the narrative now in the FEGs is that we are flipping bullish to bearish, because we've had a bullish FEG on this side. And then this FEG failed to produce the bullish reaction and then broke through and created a new FEG. You can see that this FEG holds and is supporting price to go lower, of course, right? And we can even make sense of what's going on in here. We can apply our 50% tool, see that the 50% is being respected and the bodies are trading in the lower half. You can also look at the swing points inside, or the swing formations. You have a swing formation here. This swing formation gets liquidated on Tuesday, the 14th of February. But the body closes below the swing low. And from here, we would expect that the next day is going to be very bearish. And we would look to take this swing low that's in the direction of the FEG. And then we also understand that liquidity resides below this low and below this old low. And we can use this formation to then continue to track the FEGs that develop to see how deep in this leg we want to go, right? Another thing to notice is that this failed FEG here has been reclaimed and acts as a form of resistance to push us lower. So now we have beautiful narrative at play here. We have first failure to reclaim the initial swing high, causing the first early reversal signal. The second reversal signal we have is when the ISP fails. So this FEG fails to produce the high and then is broken. The third signal we have is when this low comes in, sweeps the previous swing low here, closes above, and we're left with an FEG above it. Now we can extend this FEG and look at it to become a reclaimed FEG. So it was supposed to hold as support. It breaks through, and then it's reclaimed and held as resistance on the opposite side. And we can see here, this is also respecting the 50% of the most recent created bearish FEG. And then furthermore, we can see a sweep of the swing high with a failure to close above, giving us plenty and plenty and plenty of bearish signals, bearish confluences to go lower without just looking at some form of irrelevant break of structure by itself. We're looking at all of these different narratives, all of these different pieces to the puzzle to build a beautiful narrative that makes logical sense to help us to produce good bias for the next day, the next week, and potentially the next month. Okay. So in this candle, price pushes down, takes this low, fails to close above, but we're still here going to favor the narrative that says we're going to push up, then back down and take this low, because this narrative is stronger than the fact that we just haven't closed below the swing low, right? Because the entire narrative as a whole is operating together. It's not just one thing, right? So here again, pushes down, sweeps the low, but doesn't close above. And again, sweeps the low, but doesn't close above this low. So it'd be starting to look for, well, the price action is failing to break. Maybe we'll get a pullback. And we do. This candle pulls back, comes into the breaker, and then again begins to sell off. So from here, we'd be asking ourselves, well, if this is happening, where does price want to reverse from? What is price drawing to? In this case, it's a breaker block. In this candle, taps just into the breaker block before closing below it. In the next candle as well. We would assume here that we would be looking for, that this high gets swept because it's a bullish candle here. We're getting the reaction. We're expecting this to get swept. In this case, it doesn't, but then it sells off and closes below this candle. So immediately we'd be asking ourselves, okay, so we've come from another higher time frame pivot point, an area to continue. Where is the next draw on liquidity? And we'd be looking at this low, and we'd be looking left and seeing that this FEG as well is failing to produce higher prices. So we'd be looking for the next area of liquidity below, and we'd be looking at this low and this low. Bearish candle. The next one forms the high, the open, the high, then the low below, and then the close. Closes below the swing low, and we're expecting the same thing. Form the open, the high, the low, and the close below. In this case, it's a doji, so an indecision candle. When it's an indecision candle, if we're not in a pivot point area, which currently we're not, we're just going to assume continuations. So we assume that this would be weak. And the high wouldn't necessarily be protected. We would want to see this be traded through. If it is traded through, then we look to sell against it, okay? So in a bearish scenario, a doji candle that's not coming from a high value area where a reversal can happen, then we'd be looking to see that if this is traded through, then we would fade it. We would fade the move. We would look to sell into it. In a bullish scenario, we would look to buy into the sweep of the previous daily low in the event that we get that opportunity. In this case, we don't. It just forms the open, the high, the low, and the close, comes into the small area of liquidity in here, and it's giving us some reactions here. We can see here, failure to close below this wick, and it's making higher highs, but still failing to close below. And then what does it do? It comes, mitigates the rest of this fair value gap, and then starts to trade off, creating a swing high. And then this swing high is never traded through. But what we do see is a liquidation of the previous daily high. And because we have a bearish narrative already, we're looking to favor the bearish signals over the bullish signals. So we're not looking at the fact that this is failing to break down lower. Instead, we're not asking if it's going to go higher. We're asking what narrative is it building? What kind of reaccumulation or what kind of accumulation, manipulation, distribution pattern is forming within here? And we can see we've tapped in and then created this low, this bearish day, swept the high of it before selling off aggressively and taking out the intended lows. From here, we have a new FVG. Price pushes up, taps in, comes out, takes the low, closes above. Now we're expecting that this breaks, closes above again, gives us a reaction, looking to take out this low now after we've closed below. The following candle fails to break lower, fails to close below, comes up, closes bullish. So we'd be expecting that this candle's high would be taken and potentially be looking to see that this candle's high is taken. At this point, we have a failed ISP. Of course, we've had an earlier one on a fractal level here, but this one is much easier to notice. Failed ISP. Prices come into this order block, swept the swing high, and closed below. So what we would be expecting is to look at the next swing low to be broken, and potentially this area here. We'd look left from this region, notice that this liquidates everything in this leg. So we would look to potentially see this as an area that would produce a reaction, which it does. And then again, this area holds, pushes up, closes above previous day's candle high. And then this candle fails to close below, sweeps the high, fails to close below, sweeps the high, fails to close below, sweeps the high, fails to close below. So we'd be asking ourselves here, well, this FEG is not doing its job, right? So we'd look at the next area of liquidity to then sweep. If I carry this high over, we can see that this is swept, breaks down, this swing high gets swept, price breaks down, and then this swing high gets swept again, and price breaks down further. Because obviously, if we were mapping out our structure system, we would see that these are swing points in the market that are forming here, here, and here. And it's giving us the bearish bias, but also just understanding that we're still bearish, even though that this FEG didn't hold. What it was telling us was that we wanted to hunt the liquidity in the leg that was above this FEG. And you can see in this choppy price action, when it finally does liquidate everything else in the leg, it starts to trade off. And then from here, we have failure to close above, failure to close above, failure to close above. From here, we have a big liquidation, liquidating the most recent swing high, pushing down, closing again below the low. So we'd be expecting that next bearish candle to be produced the following day, bearish candle. And we can also see that we have an FVG here. This FVG is traded right through. And from here, we'd look for another bearish candle formation, form a buy side wick, sell side wick, and a close. Then from here, we have an FVG that's left, a BPR that's left. So price comes here and puts in a daily bullish candle. Would we be looking for another bullish candle to take out this swing high? Absolutely not, because we're following the narrative that's in the FEGs and as well as in our structure system. So what you guys can do is go back to this price action and look to use both this narrative building system on the daily as well as our structure system, and following the FEGs, the story in the FEGs on the lower timeframes like the 4 hour, the 1 hour, and even on the weekly timeframes as well. So here we've had a push down, a push up into the FEG, and from here, hold on, this dog. Sorry about that, these dogs, man. Okay, so Here we've had a sweep into this BPR, and then the next day pushes down bearish. But also we have a sweep of the previous daily high. So just like I said earlier, in a bearish scenario, this is both with doji candles where we expect continuations, as well as a bullish candle leading into an area that holds and supports our narrative, our bearish narrative in this case. So because we've taken the previous high of the day into a key area that supports our bearish narrative, are we looking to see a breakthrough and a follow through, or are we looking to fade the move? Well, in this case, we'd be looking to fade the move into the next likely area of liquidity, which would be the following swing low, and then potentially the larger weekly swing low. So this would be the previous week's low here on the Friday, as well as potentially the previous month's low, which is here in March. And you can see how all of this works together by following the narrative in the story of the FEGs, in the stories of the price action of both the highs of the candles, the formations and the closes of the candles, as well as the swings within the wicks, the daily swings. And then to make this even more concrete, what we would do is we would go into the 4 hour and the 1 hour, and we would build a narrative even further that makes sense of each day in a session by session basis, as well as just reading the price action and the order flow using our 3-tier structure system. This is applicable to monthly. It's applicable to the weekly as well. So if I go to the weekly here, we can see this is that previous week's low, pushes up. This is that previous week's swing high. So I don't want to delete this. I'll just make sure that this is only visible on the daily. Okay, so let's mark this out on the weekly now. We have a previous week's swing here. We have previous week's swing here and a previous week's swing here. So what we can see here is a push up into liquidity, and then an immediate push down, confirming this as a sweep. A sweep can be just one wick. It can also be 2 candles. It can be 1 candle up, and then an immediate retracement back into the range below the area of liquidity, which we see here. And then we'd be expecting that this low gets taken for the following week. That does happen. And then this week here puts in a bullish candle, failure to take this low. So it'd be looking at this high to be weak for the next daily or the next weekly candle. So in this trading week, we would trade below and then look to take this high and then pushes up, and we'd follow through with this logic. Okay. Now let's just reevaluate here. This is that weekly low, and let's see what that narrative looks like here. So applying that same line of thinking, we have an old weekly high here, swing point, or swing formation, I should say, and we have an FEG. So we can see that this is respected. It's respected, pushes down, pushes up, takes the previous swing high on the weekly, pushes down and closes bearish. So what we'd be looking for is to build the narrative to take out this low and then take out this low, because it's in line with the overall narrative here on the weekly, and we're reading this on a candle by candle basis. So again, if a draw on liquidity of the previous week's swing here closes bearish, we'd be expecting that this low gets taken. This low does get taken. We get a doji, and what we were talking about with dojis is we expect a continuation if it's supported by our bias. And we'd be looking that if price breaks above the doji, we'd be looking to fade that move and see it as a manipulation rather than a breakout and continuation. We'd be looking to fade a move above here and then looking to target our next likely draws on liquidity. And here, after we've hit the draw on liquidity, bearish candle, we'd be looking for this low to be weak in the following week. Just traded through. The move is faded, creates a high and a bullish candle. So from here, we'd be looking to then take out this high, potentially up in here as well. Should we get this bullish candle, this bullish candle formation, we'd look to the left and say, where are we coming from? We're coming from a high value area of liquidity. There's no liquidity in here. So why are we printing a bullish candle? Where may price want to draw to? So we'd be looking at above the old high. That gets taken. Price trades away, closes below. Doji, we'd be expecting a continuation. Neither side of this week gets swept, closes bullish. So now the narrative's starting to change because we can read the price action, look in the bodies, momentum shifting to the upside. We'd be expecting that this high is taken and potentially this high is taken. Pushes up and potentially the swing high as well. Pushes up, fails to reach the swing high, closes below this candle, forms a buy side wick, closes bearish, and we'd be looking at this and saying, okay, so we've had a take on sell side, a take on buy side. We understand that on a higher time frame, that this is a bearish leg. This may just be a retracement to collect liquidity. We push up, failure to produce a higher high, right? We have an FEG here. This FEG fails to produce as well. We break through that. Where's the next areas of liquidity to look at? We have this one here. We have this liquidity here. And we follow this rule on both the weekly, the monthly, and the daily. And then we start to watch this and how this plays out on all of these different time frames. So what I can do here as well is understand that this is the previous weekly swing. Okay. And this is the previous weekly swing low, right? So on the daily, you can see, if I just delete this off the chart, price has swept the previous weekly swing high, displaced. There's no structure break to look for. We're not looking for structure. We're looking to build narrative using FEGs and liquidity. Okay, we're liquidity traders first and foremost, and then we are order flow and then structure traders. Okay, we've swept the previous swing high, area of liquidity. We see order flow start to shift when this FEG fails to produce, and then it is reclaimed as support when we have this follow through bearish. We can sell from here and we can look at that weekly swing low to be our weak target. When we hit liquidity, we can expect a different market condition to take control. You see here, this FEG produces a reaction, fails to follow through, fails to close, and then breaks up. So we get a failed ISP. From here, we'd be looking at what areas of liquidity we could target if this fails to produce a reaction. So we'd be looking at up here, and possibly up here. Review this price action, break it down, go even further than I have here. Look on the 4 hour, make sense of each daily candle's manipulation on a 1 hour and a 15-minute. Make sense of the weekly manipulation on the daily, follow its journey, even go a step further, make sense of the monthly candles. Thanks, guys.